stock market's luck may soon be running out. The 50-cent trader, a very mysterious trader, nobody even knows if it's a male or female, if it's a hedge fund or if it's a government. Well, they tend to make trades on the VIX at just the right time, whether to the upside or to the downside. And this time, what they're forecasting is quite a market pullback. And we'll break it down for you here in this video. The mysterious 50-cent trader, no, not 50 Cent the rapper, 50 Cent the VIX trader, got famous back in about 2015 when people started to notice very large VIX trades coming in at just the right time, to the upside and to the downside. And as you can see, all of these different articles mentioning the 50 Cent volatility trader. Back in 2018, during the flash crash around Christmas time, the markets bottomed the day before Christmas, this mysterious trader put about $2.5 million into VIX contracts. He bought 50,000 of them and ended up netting $200 million off of that trade. He seems to be at the right place at the right time with the right trade. Well, now as we gear up to get into big tech earnings season, the 50 Cent trader is officially back. This time with a $17 million VIX trade on our markets. This VIX trader bets that the eerie stock market calm won't last. A trader snapped up call options tied to the CBOE volatility index, positioning for a pickup in stock market swings within the next month. A trader, nicknamed the 50 Cent trader, bought about 250,000 call contracts on the VIX index with a strike price of 17 that expire on February 14th. The trader spent about $16.7 million in premium, with each contract costing between 63 and 67 cents. The VIX hasn't traded above the 17 level since early November. It's also worth noting the 50 Cent trader is nicknamed the 50 Cent trader because he tends to pick up volatility contracts around 50 cents. Steve Stosnik, the chief strategist at Interactive Brokers, says, quote, "It's hard to know if it's an outright bearish bet on the market or an aggressive portfolio hedge after a big move. Either way, it expresses concern that we could see a bit of a pullback during or after earnings season." This trade captures potential moves on a number of key data figures, including the consumer price index, which will be released the day prior to the expiration date, as well as potential swings as companies report fourth quarter earnings. If you are unfamiliar with the VIX is a gauge of S&P 500 option activity. So when the VIX is low, that means there's a lot more calls being bought than puts. When the VIX spikes, it's an inverse to the put to call ratio. So when the VIX spikes, that means there's more puts being bought than calls. The VIX should usually stay low because markets tend to rise over time and people tend to buy calls over time. That's going to be the most profitable trade, is buying calls on the indexes because the indexes tend to rise. So when the VIX spikes, it's a fear gauge. And typically this happens when markets fall. It can spike big. For an example, the Roni Rona. The VIX was at about 12.5, where it is now, and the VIX spiked to 85. And then all throughout 2022 and 2023, the VIX would bob between 14 to 35 or even as high as 40 at times. And some of these spikes, this is a weekly candlestick chart, some of these spikes in the VIX can take place in a single week or in a 2 or 3 week time frame. It tends to happen pretty quickly. Fundstrat's chief market strategist Mark Newton says, quote, "Our October, late December 2023 rally might require a 50 to 61.8% retracement before a pushback to new highs can occur. My bias is for lower prices over the next couple of months before another rally back to all-time highs can get underway." Fundstrat is the firm that was correct in predicting the 2023 market rally. Tom Lee, I'm sure you guys have heard of him. He believes that small and mid-cap stocks could rally 50% in 2024, and the S&P could hit about 40 or 5,200 here by the end of the year, but could reach as low as 4,400 on the downside. If you're looking at the SPY ETF, that would be about 440. So that would be implying a pullback of somewhere in the neighborhood of about 7-ish%, 7 to 8% from here. But we have been noticing a very ominous trend that has been happening in the markets. Today, the SPY on Friday hit a new all-time high, but the percentage of stocks above their 50-day moving average continues to decline. And really under the surface, your interest rate sensitive names have been getting beaten down. At the same time, the index has been rising. It's happening again. What happened in 2023, where the markets were top heavy, that's happening again. Money is just going into the biggest names and leaving the, interest rate sensitive small mid-cap stock sectors. That does not exactly represent a healthy market. JP Morgan's asset management says Fed rate cuts may top forecast. They say that a reasonable base case is the Federal Reserve may cut interest rates by 150 basis points this year. That would be 6 rate cuts. Now, Jamie Dimon just came out about 2 days ago on Fox Business and said he assigns the odds of a recession much higher than the markets do for 2024. Jamie Dimon, the CEO of JP Morgan, is probably the first person that I would listen to in that regard. But it's typically not a recession that actually gives you the downside in stocks. Normally, you're already in a crash-like scenario by the time you're in a recession. So it's usually recession fears, when the data starts to look bad, when unemployment starts to rise, when stocks actually start to price in the recession and fall. Barclays also came out today and says they are shifting the first Fed rate cut forecast to March from June. What you've seen this past Thursday is CPI came in higher than expected. What happened? 10-year Treasury yields fell, and the market started to price in more rate cuts because of a hotter CPI report. Make that make sense. In fact, you can't. What it's saying is markets are fearful about a potential recession, and they're pricing that into expected Fed fund policy. You're now expecting 1, 2, 3, 4, 5, 6, 7 rate cuts in 2024. The odds of that, 39.3%. The odds yesterday were 32.5%. The odds 1 week ago was 18.3%. But check this out. 7 rate cuts is now 18.8% of the odds. Yesterday was 3.2%. So from yesterday's hot CPI report until Friday, the odds jumped from 3% to almost 19% for 7 rate cuts. The odds 1 week ago was 1.1%. That should not be happening. That is pricing in a recession. The biggest problem that we have, though, in the near term is earnings season. Now, S&P 500 projections are for 11% earnings growth. And I know you guys have heard, people say the S&P is trading at a 20 times multiple, right? 20 times forward earnings. Well, if those forward earnings come in line with the average estimate, that's true. But if earnings estimates come in, let's say 5%, the earnings number actually comes in like 5% growth, then you're trading higher than 20 times earnings. So Q1 earnings specifically are going to be very important. We're going to get a lot of full year guidance and full year outlooks from companies. If they under deliver and underwhelm the markets, that's going to be a bad scenario for stocks, considering stocks are trading at all-time highs. This would be a different story if stocks were down here in the, 420 level for the SPY, 430, 440 level. That would maybe be a little bit different. But right now, you may be pricing in more than 11% earnings growth under the surface. So that's a big problem. If Apple misses, if Microsoft misses, if Google, if Amazon misses, you're going to be in for some major downside in our markets. Just earnings season alone, if it doesn't come in as good as expected and beats the estimates, then you could easily fall back to 450 on the SPY, potentially 440, or even down to maybe 420. That would be about a 10% pullback if we did fall to 420 on the SPY. That would actually be about a 12% pullback from here. So that would potentially be enough to reset our markets and get stocks back on a healthier trajectory. Either way here, the unfortunate part is you're kind of set up for failure or disappointment over the next coming months. It's also a time in which most people are bullish for 2024. And when most people are bullish, that's when stocks tend to do the worst. When everyone is bearish, that's where the returns are actually made. So this does seem like a bit of a problem, could be setting up for a larger pullback in our markets. Let me know what you think down below in the comment section. Major things to be watching would obviously be earnings, inflation, and the path of the economy going ahead. And unfortunately, there's really not great things to say about any of those. They're all really high, either expectations or expectations for even the unemployment rate and inflation, right? We have to walk a fine line here as stocks are at all-time highs to keep this market going. Let me know what you think down below in the comment section. What do you think is coming next for our markets? Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.